Chapter 6: The Capital and Sovereignty of Human Beings. Given the definition and nature of capital thus described, this chapter will address the fundamental principle that human beings are a form of capital, and propose a theory of how that capital can be quantified. This is arguably the most critical, yet controversial principle to this proposed moral theory based on the production of capital. Without this principle, a moral theory centered on the production of capital would lack significant moral imperatives when it comes to dealing with human beings, definitely an important aspect of our personal and societal decisions. This claim of how human beings are a form of capital is critical to the following moral principles. 1. That the sovereignty of human beings should derive from their productivity, and their capital derived from their productivity should determine at what point they become sovereign. 2. That the political structure of society, that of suffrage, political benefit, and taxation, should be proportional to the ownership of capital, which includes the capital of human beings. 3. That the severity of a crime is based on how much capital was destroyed, which includes the capital of human beings. 4. That the raising and teaching of productive human beings is consistent with the production of capital. And 5. That the total capital of society should include the capital of all property, which includes the capital of human beings. However, the theory I propose of how human capital can be quantified will conflict with the commonly held moral theory of egalitarianism, the belief that all human beings are morally equal and should be treated equally. I will make my case against many aspects of egalitarianism in the later chapter on equality, arguing that while it was a significant breakthrough in political theory, where sovereignty should reside in the people and not state officials, it significantly breaks down in many other aspects of political and moral theory. I will argue that the production of capital can maintain this important breakthrough while also solving for many of the deficiencies in egalitarianism. In a nutshell, arguing that egalitarianism is justified to the extent it better produces capital, but not justified when it does not. I have alluded in the prior chapters that human beings can be seen as a form of property. Definitively, this is so, albeit a special kind of property, a sovereign form of property, a self-owning form of property. You own your body, do you not? Do you not have the exclusive right to use your body as you see fit and no one else? If capital is an attribute of property, does sovereign property, self-owning property, correspondingly have capital? I will argue that we do. I speak here of sovereign human beings. These are human beings who have property rights in their own body and the property they have created or acquired legally. We are self-owning, self-governing. But not all human beings are sovereign. We no longer have slavery, but it is clear that children and criminals are common examples of human beings not sovereign. It is not up to them to determine what to do with their bodies and their lives, at least in the present. It is instead up to their guardians. Why is this moral? Why should some human beings be sovereign and not others? What is it about the nature of human beings that should grant them sovereignty? I argue that it is their productivity. It is a human being's productivity that grants them sovereignty. This principle derives from the societal moral imperative of the production of capital. If, as a society, we want to create capital, then the point at which a human being should become sovereign is when they are more productive at managing their body and life than their guardians managing it for them. In proposing how to quantify the capital of human beings, I will show how this point of sovereignty can be objectively determined. There's one overarching problem with quantifying sovereign human beings as a form of capital, that they are not bought and sold in the market on the whole, and as such, have no active market price. Without this, we do not have our traditional tool of measurement of the capital of human beings, like we do of other forms of property. But just because you don't have a thermometer doesn't mean temperature no longer exists. You just can't measure it that way. Because we don't have our traditional tool to measure the capital of human beings doesn't mean we have no capital. If capital is theoretically a quantification of the functionality used by other forms of property, then clearly human beings have plenty of capital. So let's go back to our two methods of measuring capital, the historical cost method and fair value method. Can these methods be applied to human beings? Consider an asset that produces a net income of $19,691 annually, expected to continue for 40 years. How much would you pay for such an asset? If we apply our net present value formula utilizing a growth of capital at 5.49%, we calculate the net present value of such an asset at $316,380. Now let's consider a 23-year-old who has a salary of $52,386 and personal expenses of $32,695, including taxes, for a net income of $19,691 per year that they put towards savings and investment, which grows at 5.49%, and we expect that they will be working for 40 years. If we apply the net present value calculation to the net income of the person, as we did for the previous asset, we end up with a net present value of $316,380. It is proper to look at the net income and not just the salary. Personal expenses consume capital, so need to be factored in. An asset that makes an annual income of $100,000 but also costs an annual expense of $90,000 should be analyzed at a net income of $10,000, not $100,000. We see here that the method of using the discounted future net incomes as suggested by the net present value formula is a potential technique towards quantifying the capital of a productive human being. Of course, the current net income of a person isn't going to be constant into the future. Also, the growth of capital isn't always constant as well. The nature of both the person and society can change over time, changing how much capital either the individual or society produces in the future. The present net income and growth of capital are estimates of future net incomes and growths of capital. Also, rather than use the growth of capital of an investment in the S&P 500 for the NPV calculation of a human being, instead, I will argue to use the growth of all the capital within society. In Table 3 and Figure 2 of the appendix, I calculate the average annual growth of capital since 1946 at 3.1% in the U.S. The disparity between the capital growth of an investment in the S&P 500 and the capital growth of society is likely due to the greater consumption of capital of human beings relative to their production compared to the consumption of capital by corporations relative to their production. This is the change in all of the capital of society, which should also include human beings. Although such an adjustment for human beings is relatively difficult to calculate with current data available, and so I leave to future works. Also, rather than constrain the NPV calculation to the expected lifetime of the human being, I will argue to instead assume an infinite series of net incomes into the future. I believe this assumption is justified because much of a person's produced wealth can still exist and be productive after they have passed away, which I will speak to in Chapter 8 on capital. Given these conditions and assumptions of constancy of both net income and capital growth, an estimate of a human being's capital can be calculated via the infinite form of the NPV formula, where the net present value is equal to the gain of capital divided by the growth of capital. This gain of capital being the individual's net income and the growth of capital being the change in capital within society as a whole. Applying such a calculation to the previous example of a person with an annual net income of $19,691 and a societal annual growth of capital of 3.1%, we would instead calculate the capital of such a person at $635,194. Effectively, by using the net present value formula applied to sovereign human beings, we are using the fair value method of accounting to determine their capital, where the capital of human sovereigns is extrapolated from their similarity to other net income producing assets. For calculating the capital of a productive human being, let us address some of the details of calculating net income, profit. From an accounting perspective, net income equals revenue, otherwise known as income, minus expenses. For many individuals, their income comes primarily from their labor, i.e., their salary, as well as the appreciation of their investments or of the property they created. Their expenses traditionally come from their costs of living, such as food, shelter, and other utilities, as well as taxes. Also included in expenses is any depreciation of property owned, such as a car or forms of property that lower in market value. Now, if we are proposing that a person's body is a form of property with a quantifiable amount of capital, then we must also consider its depreciation as well. Unfortunately, we do not live forever. Our bodies depreciate over time just like any other form of property. As such, when we consider our personal expenses, we need to calculate the depreciation of our body as well. A fairly simple way of calculating such depreciation is a straight line method, where the capital of our body is depreciated linearly to zero over our expected lifetime, where in the case of persons in the US, that currently is an average lifetime of 79 years. On a yearly basis, the depreciation of one's body would be their capital divided by their expected lifetime minus their age.